It's 5 o'clock in London, it's midday in New York, midnight in Hong Kong, 2 a.m. in Sydney, 9 a.m. in San Francisco, and 10:30 at night in Mumbai. Greetings, good morning, good afternoon, and good evening, depending on where you are in the world today. We're actually in a different part of the world today because actually we're recording this show. My name is Patrick L. Young, the IPO-VID live stream, Series 35, Episode 4, that's IPO Video. Episode 208 starts here. We celebrated our 13th birthday at the weekend, ladies and gentlemen. Exchange Invest reached its teenage years. Sign up at exchangeinvest.com. The country club is coming to the city as the New York Stock Exchange, as part of the great listings duopoly, works its way through to using all of the real estate that they have elegantly managed to restore in the basement of their building is getting together. News reaches us of a fabulous new club, ladies and gentlemen. We're going to call it Club 11 Wall. Why not? It's, 43 less, but I suppose that's quantitative easing for you, or something along those lines. Certainly a measure of deflation. The idea that what used to be full of receipts and stock certificates could now become an elegant meeting place for some of the finest listed venues on the planet, amongst other financial illuminati, sounds like a magnificent idea to have at the heart of Wall Street. Good luck to Lynn Martin and the New York Stock Exchange team on putting that one together. Of course, as part of the country club IPO listings duopoly, we know that NYSE and NASDAQ are going to be very interested in hearing from our guest today. Jay Ritter, Professor Jay Ritter, is going to be discussing understanding the IPO market. Jay Ritter is the director of the IPO initiative at the University of Florida's Warrington College of Business Administration. He has been writing on initial public offerings and investing for over 40 years and is pretty much one of the go-to people that you may find in the media at all points in time when people are talking about the structure of the IPO market. Jay, it's a pleasure to have you here with us today. Greetings. Welcome to IPO Vid. If I may ask you to open the show, where in the world are you today?
I'm in Gainesville, Florida, where the University of Florida is located.
Fabulous. Now, Gainesville, tell us a little bit about that. That's northern Florida, if I'm correct.
Yes, north central Florida, about 2 hours north of Orlando by automobile.
Wonderful. What an interesting place. Not that far from Atlanta, Georgia, really in the heart of a very, very interesting entrepot of capitalism and capitalist activity and listed companies itself all around there. So tell me, how did you get into the world of financial academia?
As with many things in life, a series of accidental choices. I was an undergraduate economics major at the University of Chicago. And when I was talking with one of my advisors, he mentioned to me that business school professors got paid a lot more than other professors, something that stuck in my mind when I decided to apply to PhD programs in economics. And I got interested in finance and then chose to not go to an economics department and instead went the business school route where I started working on initial public offerings and had no idea that a worldwide boom would be occurring over the next 20 years. So there's an element of luck in life, and I was lucky to have chosen a specialty, having no ability to predict the future, but I got lucky.
You got lucky, something that I think has happened to many an IPO investor indeed over the years as well. So, talk to me a little bit about this. How did you come to be the director of, indeed, how did the IPO initiative come to be at the University of Florida?
I've had a rather unique situation for professors. In addition to publishing articles in peer-reviewed academic journals, over the years, I've talked to the financial press quite a bit. And there's kind of an interactive effect in terms of like the Wall Street Journal reporters who cover IPOs. I've talked to them many times over the years. But then there might be some prominent IPO in the healthcare industry. And a healthcare trade journal reporter is assigned to write a story about it. Well, that reporter knows a lot about healthcare, but not necessarily about financial markets, but reads other articles that have been published about healthcare IPOs and see who has been quoted. And so if you get quoted in one article, it makes it more likely that you're going to be quoted in additional articles. And what I've also been able to do is, in addition to providing opinions, is to provide facts. On my website, I have many tables, mainly focusing on the US, but also data on 55 other countries. And things come and go. For instance, the last few months, SpaceX has been the big topic of discussion.
Yeah, I mean, it's interesting actually. I mean, talking about specifically or not specifically about SpaceX, but I mean, quite incredible how the IPO market has grown. Indeed, the stock market has grown. I mean, I can remember relatively recently, we all got very excited about the idea of there being $1 trillion company. Now we're at the point where we've got this SpaceX IPO that's going to mint more billionaires than I think any other IPO in history. In fact, it's pretty much going to mint more billionaires than pretty much every IPO in history until about 20 years ago. It's an incredible moment at the top end of the IPO market, isn't it?
Yes, this is unique where if SpaceX, OpenAI, and Anthropic go public, all of them at valuations of $1 trillion or more, even if it's half of that, these are going to be the largest private sector IPOs in the history of the world.
Yeah, and it's actually also, I mean, it makes quite a material impact on several things, doesn't it? Because it makes quite a material impact on overall stock market capitalization, because even in the USA, adding $1 trillion of market cap does start to move the needle. And second of all, it also creates, of course, very interesting issues in the indexing business, because the number of megacorps at the top end of the S&P 500 are growing at the same time as actually the smallest companies in the S&P 500, global titans that they are nonetheless looking quite minuscule by comparison.
Yes, and it's as you indicated, it's mainly to that growth in the right tail, the mega caps, where wasn't that many years ago where $1 trillion corporations were unheard of, and with the exception, for instance, of Saudi Aramco. Most of the mega caps, almost all of the mega caps, are tech companies. This is not the restaurant business where there are no economies of scale, no network effects. The tech industry, some of the verticals, the narrowly defined industries, not all, are subject to either huge economies of scale or a network effect that leads itself to winner take all or only a few companies dominating that sector.
Yes, it's very interesting. So we now have, instead of what the late 19th century was an extractive oligopoly, one could say, of robber barons who were taking all this stuff out of the ground and therefore being able to own either the railroads on top of it or the oil that was coming out of it. Now everybody, those that own the ability to process the data, have themselves some incredible network scaling effect.
Yes. 25 years ago, the internet was the new thing that everybody realized that this is a game changer. Now AI is there, but AI in terms of the large language models has enormous costs of training, which results in a situation where there are likely to be just a handful of companies dominating that. But unlike many industries where even if you're a big company, competition that then limits the profit margins, with some of these companies, you've got enormous costs of creating things, but then very low incremental costs, so that you can justify spending huge amounts of money up front with an expectation of being able to have huge profits in the future.
It's really, really interesting. And also, I think what's fascinating is obviously the IPO market remains remarkably buoyant, certainly in the USA, which is a great sign because you will certainly remember, as I do, that the IPO market, for various reasons, has been written off several times in the course of the last few decades.
The IPO market in every country has cyclical patterns. It tends to be hypersensitive to market movements. When the market goes up, lots of companies go public. When the market goes down, volume slows to a trickle. But there have also been some long-term patterns going on. In the 80s and 90s, worldwide, the IPO market was booming, partly due to privatizations in some countries. But for the last 25 years, the number of companies going public has been much more limited. And in the United States, the number of listed companies dropped by 50% from its peak in 1997 until 2013. It's been relatively stable since then, with a few cyclical ups and downs. But in Europe and much of the rest of the world, with the exception of China, the number of listed companies has also been on the decline.
Yes, and of course that leads to an interesting point because there's been a lot of talk about companies either going private, staying private, wanting to be private. We'll get on to maybe the private element in a moment, but I'm curious, do you think that the IPO market has been materially impacted, particularly in the USA, by the various pieces of legislation after .com? And indeed, will an end to quarterly reporting help grow the number of IPOs?
Well, regulations do matter. Regulations and their enforcement. Russia is an example of where corruption and corporate culture has resulted in a very small number of publicly traded companies. No matter what the laws are, even if they're very pro-investor, the ability of oligarchs to loot companies, for the government to have punitive taxation of companies, has made it a situation where public market investors just have not earned good returns. In the United States, publicly traded corporations in recent years have been paying out about $600 billion of dividends every year and paying out cash through share repurchases of about $1 trillion per year. Investors in the US have been willing to fund companies because the corporate sector has been returning lots of cash to investors.
And of course, the problem with that is returning the cash to investors is one thing, but buying back the stock is a problem because we don't see enough IPOs happening to bring new content onto the stock market to keep this cycle going, I suppose.
Well, the number of companies has declined, but the total valuation has increased. Indeed, the market share of US market cap in terms of global market cap is at an all-time high. Why? Partly because of the willingness to pay out lots of cash to investors and to have been able to grow profits so much. There's compared with much of the rest of the world, CEO compensation in the US on average is very high. But it also varies a lot, and most of it is equity-based. This has the advantage of aligning the incentives of CEOs and public shareholders, and this has definitely benefited public shareholders.
Yes, and I think also it has to be said, God bless America, there are a lot more risk-oriented investors in the public markets than, say, might be seen in some other regions. Certainly, I'm thinking of Europe, where I'm coming to you from Malta today, where US investors are definitely willing to be that bit more aggressive in terms of how they price things that is obviously attractive to companies who are listing. And I think also, I mean, I'd be fair and say it's very interesting looking at, you say quite correctly, how the USA has become a dominant share of the overall listings business, and even really any decline in recent times has only been as a result of machinations of the dollar. But it's fascinating because the country club duopoly, as I call them, NASDAQ and NYSE, have truly played an incredible game in business terms. I mean, akin to the best ball game we can think of in making the USA such a popular listings haven. In some ways, despite the regulation, which is actually more onerous for listing than it is in other countries of the world.
Yes, and I didn't fully address the question that you asked. Well, the U.S. Has been able to grow corporate profits, which is fundamentally what is needed for investors to earn high returns. Regulation does matter, but I think the changes in regulation, whether the 2012 Jobs Act or current proposals, are having a relatively minor effect. That much more fundamental is the desire, especially of venture capital-backed companies, to grow big fast. And one way of doing that in many cases is by being acquired rather than remaining as an independent company. The other thing is the huge amount of venture capital and private equity money available throughout the world has made it easier for companies to be private and still have access to capital.
Yes, and so that is an interesting element, because we've seen this vast outgrowth of companies remaining private for a lot longer, as we've alluded to, and also companies attaining huge valuations while they're private. And I'm just curious, because also we've had this thing in the middle between an IPO and a late stage private company, these private markets growing up, which seem to me to be actually riddled with complexity in a lot of places. And as we've seen just recently with some AI related transactions, in fact.
Yes. One of the advantages of going public is liquidity for the shareholders of a company, both institutional, venture capitalists, employees, others. But the growth of private markets, NASDAQ private markets, Forge Global, EquityZen, et cetera, have made private markets for some companies more liquid. And others, such as SpaceX and OpenAI, have been doing self-tenders, allowing employees to sell some of their stock while the company remains private. So that's decreased the pressure from that constituency to have the company go public. The improvement in private markets has certainly advantaged private markets at the expense of public markets. But public markets still have unparalleled advantages in terms of liquidity, capital raising, access, et cetera.
Yes, I think that's very important. And ultimately, nothing works better for a good company than being placed in the public spotlight so that the largest number of people can potentially invest in that business. I suppose one of the things that's curious is that some of the advocates of private markets, I think, have been quite happy with situations where perhaps not quite such good companies have always kept ratcheting up round by round, because when they went into the public markets, they've suddenly found themselves more transparently priced and actually diving backwards, which is obviously a disadvantage. It's a very interesting. Go ahead. Sorry.
Yeah, as you alluded to, private markets have some problems as well. FTX, the cryptocurrency company, blew up a few years ago. where it turned out there was a massive fraud going on. That was a situation where venture capitalists, and including Sequoia Capital, had put money into the company, but there was so much desire from venture capitalists and others to invest that it allowed the company to not have good corporate governance and not have good transparency. Sequoia Capital, for instance, was not on the board. In general, when VCs are on the board of directors and have enough power to ask tough questions, the probability of fraud goes down. But when there's too much money chasing deals, then some bad things sometimes happen.
Yes, and I mean, it's interesting because actually, I mean, FTX is a great example. And you're right. I mean, incredibly intelligent investors like Sequoia not having the leverage because for whatever reason they got involved and they were chasing a lot of money. I always thought the interesting thing, though, was that we actually flagged in our newsletter Exchange Invest 6-9 months out before FTX went bust, because what I was able to say was, here's the problem. They were valued at, and I'm going to get the number wrong, I think they were valued at 32 billion. They were trying to raise money in advance of that valuation. They weren't able to do it. Then they came back and they were trying to raise money at that valuation. They still couldn't do it. And that's always a little tell that you can get in the market. It's a classic casino tell. There was a little twitch around the eyebrow and it wasn't quite clear. Whereas, of course, in a public market, it would be much more obvious, much faster, because you would hopefully have better corporate governance anyway, and you wouldn't get to that sort of a situation which 6-9 months later started to become quite obvious. But it's a very good point you raise. And also, I mean, moving, changing gears slightly, looking at the US marketplace, we've had some quite interesting developments in recent times. I mean, quite a lot of content, listed companies have been cleansed and so forth, because, I mean, in particular, NASDAQ have been tightening up their rules. I mean, walk us through that. Tell us a little bit more about it.
Are you referring to the recent changes for penny stock IPOs?
Yes, absolutely.
Yeah.
Absolutely.
Yeah. From 2001 until a few years ago, there were an average of only about 5 penny stock IPOs per year in the US, most on NASDAQ. So, a typical penny stock IPO, usually at $4 per share. The definition is below $5 per share. Usually we're only raising $6 million, so the amount of money being raised was small. But then in 2024 and 2025, there was a huge surge in these penny stock IPOs. Many of them, but not all, from East Asian countries, China and Hong Kong in particular. Some of them were pie in the sky companies, but actually more of them were profitable than typical operating companies going public in the US that are larger. But when you looked at a lot of them, a noodle shop chain in Hong Kong with $10 million of gross revenue, profits of $1 million, competitive industry. Okay, even at a price earnings ratio of 20, maybe a market cap of $20 million would be justified, but the company was going public at a market cap of $40 million. And almost all of these penny stock IPOs have crashed and burned. Some of them were frauds, but a lot of them were just overvalued. They were sold exclusively to unsophisticated retail investors. And what NASDAQ did late last year is proposed a rule change saying that the minimum proceeds had to be $15 million and 25 million if the company was from China or Hong Kong. And this minimum proceeds requirement has almost completely eliminated the penny stock IPOs.
Yes, very interesting altogether, and certainly quite fascinating. One of the things that I always thought was intriguing was there was this rise in these penny stocks going to Nasdaq, and as you say, they appeared to be often very profitable. At the same time, we had Charles Lee, the former boss of the Hong Kong exchanges, launching his micro exchange initiative, or the Macau exchange, as it's called in some places, Micro Connect, and they were actually crunching all the data, as you can do, because China basically is a cashless economy. And it was quite interesting because you could very quickly benchmark just how profitable any noodle store is in the country, because they are quite literally bringing together the valuation of every noodle store, right to the point where they can tell you that I think there's something like, I'm going to get the number wrong, but off the top of my head, I seem to remember Charles telling me it's sort of 8:47 p.m. on the night before the start of Golden Week. And actually here we are actually recording this during Golden Week, is the point in the year when you sell the least takeaway noodles, because everybody is already on their way back to their parents, with their parents and family, or alternatively, the only people eating in the noodle bars are basically people who work in the security of the buildings and didn't get the week off, or some other, sort of low level worker who hasn't been able to move. So yes, it is a fascinating instance as to how that's been tweaked overall. And tell me, I mean, you do research, I know, in the rest of the world. The United States of America is dominant at the moment with whatever, depending on how you value the dollar, 60% or 70% of the world stock market capitalization, which is, well, it's astounding even for those of us who remember Japanese dominance. And I think they only got about 45, 50% of world market cap at a point in time of an outrageous bubble altogether. How do you view the rest of the world's IPO market? And I appreciate that's a huge question to ask, given the fact you even look at 55 markets.
Well, industry has a big effect on things. Where the U.S. has been most successful, the U.S. and China, is with tech companies. Some companies that have been able to grow their profits and revenues enormously. There are a few in East Asia as well. Taiwan Semiconductor Manufacturing Company, SK Hynix, Samsung Electronics, and then ASML in Europe, of course. China has some great technology companies, but the government is putting pressure on them to limit their profits. And even within the U.S., 49 states envy Silicon Valley. The rest of the world envies Silicon Valley. But if you ignore the big tech companies, Europe and the US are not that much different in terms of other industries going public, a relatively small number of companies. And I think partly that's due to the availability of private equity. Now, it's not only the availability, it's the terms on which it can be raised. Historically, the idea, especially with venture capital, was that a company would go public because public equity was a cheaper source of capital than venture capital, where the middlemen, the general partners were getting fees and performance fees. So there's a wedge between what limited partners are receiving and what the company is paying in terms of the returns. But to the degree that large supply of money has driven up the prices that the VCs have to pay, that's lowering their expected returns. And for the LPs, after fees, that the returns have gotten even lower. So it's not clear to me that the cost of equity capital to the companies is that much different between private markets and public markets. Now, what that means for the LPs is if the returns are not that much different before fees, on a point forward basis, I'm not sure that LPs are going to be earning even as much as they could earn in public markets.
That's very interesting, actually. We're going to go to a break in just a second, but I just want to follow up on that because then that asks a question, Jay, which is how could equity markets further improve themselves? Are there ways in which equity markets for IPOs could become a more efficient process to further reduce the cost of equity to go to public markets?
Well, an IPO is more expensive than it needs to be. There are not only the fees, which are much higher in the US than the rest of the world, but also the money left on the table. The fact that on average, IPOs start trading at a higher price than the offer price, so that a company is selling stock at less than public markets are willing to pay. Auctions, direct listings can eliminate some of that wedge. But the evidence is that direct listings and auctions have not been very popular.
Yes, that old issue, the stag, that animal that the British stock market used to talk about a great deal, those who would buy in at the IPO and sell quickly for a profit, retains a certain element of excitement in the overall market. I'm going to give you a break for just a second, Jay, because you've been encapsulating a fabulous, very, very broad portfolio of IPO discussion. Ladies and gentlemen, I mentioned stags and the British Stock Exchange. And of course, when we look at the City of London, we see incredible history. And history has been made recently, ladies and gentlemen, by none other than, wait for it, the world of human resources professionals. Here's a short video. Meanwhile, in Big World, in case you missed it, on February the 3rd this year, 2026, the latest guild company was elevated to livery status in the City of London. A scant 10 centuries, yes, a whole millennium, after the weavers were first elevated in 1155, the Court of Aldermen and the Lord Mayor approved the livery status of what is now recognised as the Worshipful Company of Human Resources Professionals, the 114th livery company in the square mile. For more in Big World, like or follow. And let me say, I'm a proud member, in fact, a proud liveryman of the Worshipful Company of World Traders, which was the first millennial company to be so granted. Seems interesting. It took us 1,000 years to get towards world trade. Somewhere along the line, globalization wasn't as great as some might have said it was going to be. Now, that brings us elegantly talking about world trade, globalization, and the world of digital markets. Let's throw those all into one thing. This week's book of the week, well, it's celebrating really the 13th anniversary of Exchange Investors, the newsletter. It goes all the way back to 1999, Capital Market Revolution, the original book by one Patrick L. Young, whatever happened to him. And on our 25th anniversary, of course, you may recall, we had the joy of going to the New York Stock Exchange and meeting the President Lynn Martin, who invited us to ring the historic bell of the New York Stock Exchange at close trade on July the 5th. Capital Market Revolution, you can catch the Amazon Kindle version. It's the 25th anniversary. It's got 10,000 extra words talking about how digital markets and the whole world has changed over the course of the last 25 years since the original best-selling book of fintech was written. And you can catch that at a very, very reasonable price indeed, ladies and gentlemen. Go get your copy on Amazon right now. And we shall return to a fabulous discussion with Professor Jay Ritter, the man who is in charge of the IPO initiative within the University of Florida. Jay, it's a joy to have you on the show today. We've been talking about a wide range of things right the way around the world. Mostly we've been looking at the larger end of stocks, and then we had some of those very, very micro caps, the penny stocks you were talking about that NASDAQ has recently clamped down upon. What about the MSME or middling tier of IPOs? Because it's interesting, the world has a huge vogue towards developing SME markets, or however you want to call them. And of course, those market cap thresholds vary enormously from the USA, where you're almost a large cap when you're an SME, to the rest of the world where you wouldn't qualify for NASDAQ in a month of Sundays. How have those SME markets gone? I'm quite intrigued because you've had a very, very broad view of them around the world.
Many countries have created junior markets to make it easier for SMEs to access capital. Overall, they haven't worked out too well. Part of the problem is that usually you've got the main market that creates a junior market with the idea that the successful companies that list on the junior market will grow and then move to the main market. This works okay if you've got IPOs in the economy doing well year after year. But if there's a market downturn and the flow of new IPOs slows up, who's left on the junior market? Well, the loser companies. And so they get a little bit tainted. Uh, and overall, the junior markets have not done very well. And part of the problem is that a lot of the smaller companies going public have been disappointments. Now, that in itself isn't a problem. After all, for venture capitalists who are investing in startups, they expect that the majority of companies that they're investing in are going to be total failures. But they're counting on enough big winners to offset the many failures. The problem with a lot of the junior markets is there haven't been enough big winners to offset the disappointments. Uh, and I think this problem has probably gotten worse over time because of the availability of venture capital and private equity, where a lot of the good young companies are able to get that private financing without needing to go public when they're at a small scale. And so you get some adverse selection. Who's going public, like with these penny stocks in the US? Well, by and large, these are the companies that venture capitalists have said, we've looked at you, we've done our due diligence, and no thanks. We just don't see enough upside potential for you. And so a lot of the companies that go public on these junior markets just aren't ready for prime time.
Yes, just not ready for prime time. And obviously, that's a difficulty. And certainly, I've noticed a lot of particularly European exchanges have been working very hard in order to develop their markets and actually running sort of IPO academies and so on to try and make these younger companies fully ready to go into the public markets environment. Have you any thoughts on what way we can try and help develop the SME marketplace for IPOs, allowing for the fact that there are clearly going to be companies that are not going to succeed?
Well, one thing that we haven't discussed is regulations in Europe, in particular. The U.S. venture capital market, which mainly is focusing on life sciences, biotech, and tech companies, has invested in lots and lots of failures, but there have been a lot of really big winners. Uh, and those really big winners have been able to boost the average returns. Europe, where Sweden's a bit of an exception, hasn't had much of a right tail.
Mm-hmm.
Why? Partly it might have to do with the fact that between Brussels and 26 different country regulations, uh, companies have to spend lots of time, lots of resources on regulatory issues and less of their resources on coming up with innovative products and great new ideas and products. Now, that doesn't mean there shouldn't be any regulation. It's difficult for countries, for regulators to get the trade-offs right in terms of protecting investors, protecting consumers, um, and facilitating innovation and capital formation. It's not easy to define a set of rules, and the set of rules might depend upon the industry as well. With biomedical stuff, there could be side effects that are potentially resulting in very bad health outcomes. On the other hand, excessive regulation stifles innovation, makes it too expensive, and there's that opportunity cost of things that aren't developed.
Yes, and it is a very, very interesting series of points you make. And certainly, I mean, I'd be the first one to put my hand up and say the European Union has ended up horribly overregulated in many, many ways. But there is this lovely bright spot in Sweden where truly, well, really, the Swedes and Scandinavia helped themselves. They've built a very, very proactive ecosystem promoting IPOs, promoting the investment, creating value. And in fact, we had Erja Retson, who's one of the people behind the SME market there on this show, good grief, 5 years ago, I think. Roland Chai, the European boss of NASDAQ, more recently. You can catch those in our back issues, ladies and gentlemen. But it's very interesting, Jay, because they have single-handedly hewn out an amazing SME market structure that really does help encourage companies to grow, delivers investor returns, delivers tax breaks, admittedly, to the successful investors as well, which incentivizes them to keep going. And it is a fascinating example of how you can make one of these SME markets work with a little bit of effort and indeed a great deal of cooperation between the investors, the entrepreneurs, and the exchange itself.
Yes, I mentioned that Europe probably has too much regulation. On the other hand, the US probably has too many lawsuits. Lawyers, plaintiff lawyers do discourage corporate wrongdoing, but it can also be excessive. Korea has relatively few investor lawsuits, class action lawsuits. They probably have too few. The US almost certainly has too many. This is another example of getting the costs and benefits balanced correctly is really difficult.
Getting that balance is incredibly difficult. And obviously, I mean, having written the book Capital Market Revolution 27 years ago now, I'm quite intrigued to know, Jay Ritter, from your perspective as the international expert in academia and IPOs, and as someone who has seen so many of these cycles take place, Jay Ritter, where do you think the capital market revolution goes next?
I think there are going to be gradual trends going on, but AI is the big question mark in labor markets and financial markets. Nobody knows how it's going to all play out. It looks like there are going to be incredible productivity gains in many areas, not in every industry. These changes are going to be very disruptive. In agriculture, there have been productivity gains gradually for well over 100 years. And because the productivity gains have been gradual, they haven't been very disruptive. With AI, things are moving so fast that it does look like there's going to be a lot of disruption. For financial markets, for many companies, they'll be using AI to increase productivity. The restaurant business probably isn't going to be affected a great deal. It's labor intensive. Inputs of the raw materials are important. You still got the rent and heating and cooling for restaurants, etc. But a lot of other industries, things are going to be moving very fast. And this might, in many cases, be doing what the communications revolution and the tech revolution of the last 50 years have done, where in many industries, being a smaller company, a mid-sized company, has become unattractive relative to being one of the biggest players. We've seen this in many industries where a handful of the biggest companies are the most efficient, and they've made it very hard for smaller companies to compete effectively and have competitive profit margins. So this might result in the continuing trend to fewer small publicly traded companies and some very highly valued companies.
What a fascinating review. Thank you very, very much, Jay Ritter. It's been an absolute joy to chat to you. Disruption will carry on, ladies and gentlemen. The revolution continues. At the same time, we need to balance the acrimony of the litigious American system against the overregulation of the Europeans and many other interesting factors aside. Valuation remains a key. How we're going to look at the IPO market going forward could be a concentration on many, many more small number of vast IPOs. So therefore we prepare for the blast off of SpaceX, which is going to take place in the near future, I suppose. Those are just a few of the top line remarks that have been offered to us today. Jay, I really hope you can come back and join us another time so we can talk about IPOs in more detail. It's such a fascinating realm of what goes on. Perhaps someday we'll have an opportunity to meet in New York and share a pleasant beverage at whatever it's going to be called, Club 11 Wall Street, within the heart of the New York Stock Exchange. Who knows? Thank you very, very much for your time today. Thank you very, very much to our fabulous production team today, to Desiree, Herminia, and Janella. We are off because it's going to be a Memorial Day next week, an appropriate day to remember many, many things, and not just as a petrol head am I saying the Monaco Grand Prix and the Indianapolis 500, although those are obviously highlights of the Memorial Day weekend when we can pay tribute to those many people that we remember from amongst the fallen. IPO-VID will be back in June, by which stage I will be in Southeast Asia. Ladies and gentlemen, it only remains for me to say I wish you all a great week in life and markets. Thanks again to our guest, Jay Ritter, for making such a fabulous show talking about the IPO market. And also, of course, if you've got a marketplace you'd like to build yourself, then let me know. Get in touch. And in the meantime, you can always rely on Exchange Invest at exchangeinvest.com to be the water cooler of the Bourse business, the exchange of information. I wish you all a great week in life and markets.